All right, listen up. In January 2026, a massive storm is set to hit the commodity markets. We're talking about a predictable, mechanical wave of money, billions of dollars in forced selling and buying. But here's the thing. This has absolutely nothing to do with geopolitics, inflation, or economic news. This is a ghost in the machine.
I mean, really think about that. What if billions of dollars were forced to trade on a pre-programmed schedule, completely ignoring the headlines? That's exactly what's about to happen. It's called the annual Commodity Index rebalancing. It's a purely technical event that creates one of the most intense, concentrated periods of market flow all year. And it's about to cause some serious distortion.
And here's the kicker. This all goes down in an incredibly tight window. Sure, you'll see some traders trying to get ahead of the game in late December, but the real action, the real fireworks, they kick off around January 8th. The peak concentration, the eye of the storm, hits between the 8th and the 15th. That's when the machine goes into absolute overdrive.
So let's dig into what this anomaly really is. What we're about to witness is this temporary but incredibly powerful disconnect between a commodity's price and its actual fundamental value. It is the ultimate showdown, market mechanics versus market reality. And this is the part you really have to wrap your head around. For these couple of weeks, the algorithms and the giant passive funds tracking these indices, they're not thinking. They're not making decisions. They are simply executing orders based on a new set of rules published months ago. They are forced sellers and forced buyers. And the crucial part? They literally do not care about the price. All right, so let's pop the hood and take a look inside this rebalancing machine. How does this whole thing actually work? And what makes these forced flows so incredibly powerful? It all boils down to one term: index rebalancing. Every single year, the big commodity indices reset their targets, and all those passive funds and ETFs that are built to just blindly copy those indices, well, they are contractually obligated to buy and sell billions in futures contracts to match those new weights. It is not a suggestion, it is not optional, it is an order. Now, in this arena, you've got two heavyweights: the Bloomberg Commodity Index, or BCOM, and the S&P GSCI. And they operate with completely different playbooks. BCOM aims for diversification. GSCI, on the other hand, is all about weighting by global production, which, let's be honest, usually just means a ton of energy. And it's this fundamental difference in their DNA that's about to spark a massive conflict. And this, right here, is where the story gets really, really interesting. Because in January of 2026, these two titans of the index world are going to issue completely contradictory orders to the market. I mean, just look at the sheer scale of this disagreement. For every $1 billion tracking these indices, BCOM funds are forced to buy over $17 million of cocoa, while at the same time, GSCI funds are forced to sell nearly $35 million. You see it in Brent crude, too. BCOM buys, GSCI sells. This isn't some small discrepancy, folks. This is a head-on collision of mechanical flows. So what happens when these two forces collide? Well, you get predictable chaos. You've got two massive, non-discretionary, automated trading programs slugging it out against each other in the open market. This creates these wild swings, this extreme short-term volatility, and temporary price dislocations that are completely untethered from reality. And all this mechanical churning in the paper market, well, it creates a fascinating disconnect from the physical world. It's the ultimate signal versus noise problem. You have to understand, we're talking about two distinct worlds here. This rebalancing event, it's a pure paper market phenomenon. It all happens in the world of futures contracts, ETFs, and derivatives, numbers on a screen. Meanwhile, the physical market, where actual barrels of oil and actual bars of gold are being bought and sold by real users, is operating on a completely different set of drivers. And the noise from the paper market during this window is going to be deafening. We're going to see intense volatility, huge orders slamming the market right at the closing bell, and some really bizarre distortions in the pricing curves. For anyone who's over-leveraged, the risk of a margin call becomes very, very real when these mechanical waves start to hit. But, and this is the crucial part, while the paper markets are being tossed around in this artificial storm, the real-world story, especially for precious metals, could not be more different. The physical demand signal is absolutely screaming. Let's look at the hard data. Projections show that central banks and physical investors are going to be buying an average of 585 tons of actual gold every single quarter in 2026. These are price-insensitive, long-term buyers hedging their bets. They are not selling into some paper-driven dip. And based on that powerful physical demand, major banks are forecasting an average gold price of over $5,000 an ounce by the end of 2026. You see, this long-term forecast is based on fundamentals, and it completely ignores the short-term mechanical selling we're about to witness.
Now let's talk about silver, because the physical story here is even more dramatic. By 2025, we will have seen 5 consecutive years where the world physically used more silver than was produced. 5 straight years. This isn't a fluke, it's a deep structural supply and demand imbalance. And the demand for physical silver, it's pretty much non-negotiable. It's irreplaceable for the green energy transition. You can't make today's high-efficiency solar panels without it. Plus, starting in 2026, the EU is mandating solar on new buildings. And to top it all off, the US government has now officially designated silver a critical mineral. This is long-term strategic demand that is completely immune to a 2-week rebalancing event in the paper market. So you've got the paper market screaming, "Sell!" while the physical market is yelling, "Buy." How in the world do you find the opportunity in all that noise?
So the question becomes, what does the playbook look like for an event like this? How can an informed trader or investor use this predictable mechanical chaos to their advantage?
Well, looking at historical patterns, a few strategies usually emerge. You have the frontrunners who try to get positioned in late December before the forced flows really hit. Then you have the dip buyers. They'll wait for that peak chaos between January 8th and 15th, looking for those artificially created bargain prices. And finally, you have traders who look to fade the moves in late January, betting that prices will snap back to reality once the mechanical pressure is finally gone.
But here's the key takeaway. No matter the approach, this is an artificial, flow-driven event. It is not a reflection of true value. The long-term physical story is real. The short-term selling is just a function of the machine.
And that leaves us with the ultimate question. It perfectly summarizes the entire conflict between the paper and physical markets, and it gets right to the heart of the opportunity this disconnect presents. The machines are selling. Are you buying?